This is the PowerPoint presentation on Chapter 3. Chapter 3 covers the adjustment process of the accounting cycle. In Chapter 2, we covered the first 3 steps: the recording of the journals in the general journal, posting to the T account or the general ledger, and then the preparation of the trial balance. For the purposes of this course, we will not be preparing the adjusting entries or doing the posting. I'm going to explain the process to you, what it is, why it happens. Once the adjusting entries are journalized and posted, then we can prepare an adjusted trial balance. However, we're not going to do that either. We will have the adjusted trial balance available to us, and it is from the adjusted trial balance that we will prepare the financial statements. And this slide just lists the learning objectives for this chapter. Alright, as we already know, accountants, when they prepare financial statements, divide the economic life of an entity into time periods. So as you can see, it can be monthly, it can be quarterly, or it can be yearly. And this slide just is just a reiteration of that. This is an important distinction to make: accrual versus cash basis accounting. First of all, accrual basis must be used for financial accounting purposes, and that is compliance with the generally accepted accounting principles. So, transactions are recorded in the period in which they occur. So, companies will recognize revenues when they have performed a service or delivered a product to a customer, whether or not they have received cash, received payment. However, they must have reasonable expectation that they will be paid by the customer. Expenses are recognized when they are incurred, not necessarily when they are paid, but when the benefit is derived from that expense in terms of helping the entity generate revenue. Cash basis accounting, in that case, revenues are recognized when cash is received, expenses are recorded when cash is paid. And as the last bullet says, we cannot use cash basis accounting in accordance with generally accepted accounting principles. This type of approach would be okay for a small business, like the local farm stand. According to the revenue recognition principle, revenue is recognized in the period in which a service or a product has been delivered to a customer. Once again, it does not matter if the cash has been received at that time. To reiterate what I already said, there must be reasonable expectation that the customer will pay the business. We next go on to expense recognition. And also as part of that, we have the matching principle. First of all, expenses must be recognized in the period in which they are incurred, and they must be matched against the revenues which they helped to generate. So what we have in this graph or illustration, if you will, is a summarization of the principles we just went through and the relationships. Right, so now we come to the adjusting entries. First of all of the transactions that have occurred within the accounting period are not necessarily reflected in the adjusted trial balance. So therefore, the accountants must go back and look to see if there are transactions that have occurred that have not been recognized. So in doing that, we're making sure that we stay in compliance with the revenue recognition and the expense recognition principles. The adjustment process is required every time a company prepares its financial statements to ensure the accuracy of those financial statements. And adjusting entries will include one income statement account and one balance sheet account. And you will see that as I show you some of the illustrations. This table provides a summary of the four major classifications of adjusting entries. First, we have deferrals. In that situation, expenses are paid for before they are actually incurred. Unearned revenues, cash is received before the revenue is earned. Under accruals, revenue is recognized before cash is received. So in other words, a product or service has been delivered to the customer before the customer remits cash to the business. And then accrued expenses are recognized as have been incurred but have not been paid for yet. What we have here is a trial balance as we would have prepared in Chapter 3. As I mentioned before, this trial balance does not reflect all of the journal entries or all the transactions that occurred within the accounting period. So it's from this trial balance that we then go into the adjustment process. And what you're going to see on a slide later on, we're going to have the adjusted trial balance for Pioneer Advertising, and you're going to see that the list of accounts is much longer because there are accounts that we use in the adjustment process that are not used during the regular accounting period. So these entries are recorded at the end of the accounting period, so therefore these different accounts will be used at that time. So what we said here for prepaid expenses is that we're paying before we receive the benefit. So when the payment is made, what is recorded is an asset. And what we have here is a listing of the types of assets: insurance, supplies, advertising, rent, buildings, and equipment. As we receive the benefit from that asset, then what we would be doing is increasing the expense account and decreasing the asset. So we'd be transferring a portion of that asset amount from the asset account to the expense account. For our purposes in this course, once again, we will not be doing the journal entries. This is just to give you an understanding of how this works. Depreciation is considered a prepaid expense. When an organization buys a fixed asset, whether it be plant, buildings, equipment, land, motor vehicles, etc., what they are doing is they're buying the future service that they will get from these assets. So when they purchase them, they're recording an asset, and then they're decreasing cash and or incurring a liability like a note payable or a mortgage payable. Depreciation is a process of allocating the cost of that asset over its useful life. And this is something that we'll talk about in Chapter 9 when we talk about fixed assets or plant assets. So what we're doing here is we're recognizing depreciation expense and matching it against the revenue that those fixed assets help to produce. And the other thing that I want to mention about depreciation expense is it is a non-cash expense because you have paid for the fixed assets up front. And here is an illustration of a journal entry, an adjusting entry for depreciation. So quite quickly, for Pioneer Advertising, the depreciation on equipment is $40 a month. So they're debiting depreciation expense and crediting accumulated depreciation for $40. Depreciation expense would be reflected on the income statement, and accumulated depreciation is a contra asset account. And on the balance sheet, that would be subtracted from the cost of the equipment of $480. So that if we subtracted the $40 in the accumulated depreciation account from the cost of the equipment of $480, we would have a book value of $440. I know I went over that quickly, but when we get to Chapter 9, I will spend more time on that. In this slide, we have examples of prepayments, the reason for the adjustments, the accounts before the adjustments, and the adjusting entry. I'm just showing those to you. Those are things that you can review on your own. If you have any questions about them, of course, you can let me know. As we've said before, with unearned revenues, business is receiving cash before it delivers a good or service to a customer. So the business owes the customer something, and in this case it's unearned revenue. So there are examples of unearned revenues where cash is received before the service is delivered to the customer. So rent, airline tickets, magazine subscriptions, and customer deposits. So in terms of unearned revenue, what's going to happen when an adjusting entry is made, when part of that unearned revenue has actually been earned, the liability account will be decreased and revenue will be increased. So in other words, the appropriate portion of unearned revenue is transferred from the liability account to the revenue account. And as we saw with prepaid expenses, we have another table set up that gives you information on unearned revenues. I give you examples of unearned revenues, reason for adjustment, accounts before adjustment, and the adjusting entry. So now we go to accruals. So we talked about deferrals. Now we're talking about accruals. So in this case, revenues for services performed or goods delivered, but they're not yet recorded. So there has to be an adjusting entry made. So also these accrued revenues, the cash has not been received. Expenses that have been incurred, they haven't been paid or recorded. So of course, adjusting entries are required. So if we look at accrued revenues, and what we see here is that services have been performed, so revenue can be recognized, the earnings process has occurred, but the cash has not been received or recorded. So an adjusting entry would have to be made to recognize the revenue and to recognize that the company will receive the money. If we did not do that, revenue would be understated, which would understate net income, and assets would be understated because we would not have recorded an amount in accounts receivable. So what you see here is when an adjusting entry is made to accrue revenues, as I said before, an asset would go up, which would be accounts receivable, and then revenue would go up as well. And once again, we have a summary table, as we've seen with unearned revenue and prepaid expenses. I'm not going to go through that again. Right, now we have expenses. So we have accrued expenses. The expense has been incurred, but payment has not been made, and the expense has not been recorded. So there are some examples that they give of accrued expenses: interest expense, taxes expense, and salaries expense. So when an adjusting entry is made for an expense, what will happen is we would increase an expense account and also increase the liability account. The expense would be reflected on the income statement, which would result in a decrease in income. And then the liability, of course, would be reflected on the balance sheet. So there'd be an increase in the liabilities on the balance sheet. And once again, we have that table to summarize the major concepts for accrued expenses. On this next table, we have a summary of all the basic relationships by type of adjustment, the accounts before adjustments, and the adjusting entries. So that's another way of presenting what we've already looked at. Alright, so once the adjusting entries have been entered into the general journal, and by the way, this is done on the last day of the accounting period, so they're recorded in the general journal, then the debits and credits from the adjusting entries must be posted in the general ledger or the T accounts. And then the adjusted trial balance would be prepared to make sure that the debits and credits are equal. Now, as we discussed when we looked at the trial balance, the fact that the debits and credits are equal does not necessarily mean that there have been no mistakes made. So that's just something to bear in mind. Once we're satisfied with the preparation of the adjusted trial balance and there's a reasonable expectation that we believe it is correct, then it is from the adjusted trial balance that we prepare the financial statements. So the income statement, the statement of retained earnings, and the balance sheet. So the next slide is an illustration of the adjusted trial balance. So this is Pioneer Advertising. If you look in your textbook or if you go back a few slides, we are going to see that the adjusted trial balance has more accounts, and the account amounts that are highlighted in red reflect the adjustments that were made before the financial statements could be prepared. So we've seen a slide similar to this before, and what we have here is we have a diagram, and it shows first of all the income statement. We know the income statement has to be prepared first because the net income or net loss is necessary to prepare the retained earnings statement, and then the updated balance on the retained earnings statement is necessary to prepare the balance sheet. And these last two slides show where the information is taken from on the adjusted trial balance to prepare the income statement, the retained earnings statement, and finally the balance sheet. This is very similar to the presentation that we had, I think it was in chapter 1, that illustrated the preparation of the financial statements. But now, as we move along, these financial statements are going to become more sophisticated because of the additional accounts that we have added. And that concludes the lecture on adjustments.